Welcome to Financial Planning Explained. I'm your host, Mike Menninger, Certified Financial Planner, owner and founder of Menninger Associates Financial Planning. Pleased to have Nick DeVito joining me today. He's one of the associates. Nick is also a certified financial planner and certainly one of our good CFPs around here. Nick, thanks for joining me.
Okay, thanks for having me.
So, kind of came up with, based on popular demand, we've had a lot of people, and we could tell based on the number of views on our podcasts and our videos and YouTube, et cetera, that the general questions tend to be, we get a lot of popularity. So what we did is we used AI.
Yes, we
How about
did.
that? It's pretty cool, huh? Mm-hmm. All right, so yeah, you're going to take the old dog and try to teach him new tricks. That's not always easy to do with me. But anyway, so what we did is we had AI generate questions that are frequently asked as it pertains to financial planning. And we're a group of CFPs. We emphasize the areas of financial planning as the foundation of doing comprehensive financial planning. And so this really worked out nicely. We were going to follow the format. I mean, if you take a look at the 6 areas of financial planning are cash management, tax planning, insurance planning or risk management, investment planning, retirement planning, and estate planning. We're going to jostle them around a little bit. I mean, they're all interactive and intertwined with each other or integrated with each other. But what we're going to do is going to really tackle sort of a general thing. And so this is going to be a series of episodes. But what we're going to do today is we're going to tackle the first one, which is general financial planning. So what we're going to do is we're going to present the question that was generated by AI and how they generated it. I don't know, was it frequently asked questions? Do you have any idea?
In terms of how we prompted it to answer?
Yeah.
Yeah, so it was just what are frequently asked financial planning questions, and then we asked for a list of them, and it provided a list, and then we kind of fine-tuned it from there to more so fit a podcast format and go from there.
Perfect. All right, well, you ready to get started?
Yeah, absolutely.
All right, so we're going to tag team on this. The very first question was, it's a great first question. What is the first step in getting started with financial planning? Nick, you want to take that?
Yeah, absolutely. So I think the first step for anyone is really about getting organized. You need to have everything in one place to really then be able to dive deeper and analyze it. So we emphasize getting organized to start, and what can that look like? That can be getting a handle on what do you have? What are your assets? What are your debts? Understanding your cash flow situation, your income, expenses. What we tend to do, and this kind of lines up with what we do with our clients. When we first onboard a new client or first start working with someone, it's all about getting organized. We're trying to develop a balance sheet for them, looking at their assets and their debts. And then you can dive a little bit deeper from there. And then we're looking at their income and seeing how much they're making, which also, once again, lends us, it leads you down a rabbit hole oftentimes, and you find out when you're getting organized, oh, what about this? And when you're looking at income and a paycheck specifically, you can then ascertain so much from a paycheck.
Oh.
Looking at, 401k contributions, any other employer benefits. So wrapping your arms around it, creating that balance sheet, and getting organized from a goals perspective as well, I think is also important, is figuring out what your goals are. Once you kind of get a handle on everything and you have an idea of what you got, well, then where do you go from there and what are your goals?
So the other thing too is the insurances. So we always say it's a 3-banger. Pulling your stuff together to Nick's point, the balance sheet, which is the assets and the debts, the income, an amazing amount of information that is on a pay stub. And, because it shows how much taxes are being withheld, how much they're withholding for their 401k. Is it traditional? Is it Roth? Do they have disability, long-term disability, short-term disability? Are they paying for life insurance, et cetera, et cetera? And the tax piece also gives us an idea of being able to assess whether or not they're withholding enough. And it's remarkable how many people we find that are way under withholding and can't understand why they owe several $1,000s in taxes at the end of the year.
And I think another benefit of really getting organized and creating that balance sheet is you'll find oftentimes people will come to us and they have accounts everywhere. And one of the first recommendations we may make to them is, hey, let's try to consolidate some of these. You have a couple old 401ks lurking out there. Maybe you have a couple IRAs lurking out there. Let's consolidate them, make your life a little bit easier so you don't have to worry about how many accounts you have at this place and the other place. Just consolidate them. And I think wrapping your arms around it, creating that balance sheet really lets you understand what you have out there so then you can consolidate from there.
That's right, because it creates a sense of awareness, particularly with bank accounts and debts. You may have, $5,000 credit card here and a car loan here, but until you aggregate them and all of a sudden it's like, holy cow, look what I've got going on, you may not realize what you have. But then on the flip side, you may not realize what you have as far as assets either.
Yeah.
And to your point of aggregating them, it makes it more organized and oftentimes more efficient.
Yeah, absolutely.
And again, we like to take a look at debts first. So anytime that you're looking at your debt, it's important to understand how much you owe, what the corresponding interest rate is, and what's your payment, and what the maturity date is. Now, a mortgage statement is a perfect example of what is provided because it gives those four things. And so when you're pulling it all together, to Nick's point, is when you're building the balance sheet, it enables you to compare what you have in assets, what you have in debts, and there are a whole lot of things that you can do once it's together.
And to your point, specifically with the debt, once you consolidate them from a balance sheet standpoint, you get it all on one page, that's when it allows you to really decide, which am I tackling first?
Right.
And that's when you can prioritize. It's hard to prioritize when you don't know what's out there.
That is correct.
So that's a great first step.
Well, it's funny, you might ask, is the next question is, what should I prioritize when I create my financial plan? Well, the prioritization is, again, first, is pulling everything together, getting organized, and taking a snapshot of what you've got going on. From this point moving forward, what are you prioritizing? Well, what are your goals and objectives? Okay, goals and objectives and cash flow. Now, cash flow is very simple. How much you making, how much you spending, and hopefully you're positive. If you're negative every month, that's when we begin to need to deep dive into how do we improve debt management, debt efficiency. And if you're positive in cash flow, then it becomes a whole lot of other things, such as, are you saving? Do you have an emergency reserve? Can you use that additional cash flow to help pay down debt? Can you use that additional cash flow to increase how much you're saving? Is it better served to put it in your 401k? Is it better served to put it in a regular investment account, an IRA or a Roth IRA, or an emergency reserve fund, or basically, again, you can see what we're doing is we're matching up what do you got going on, and what are your goals and objectives?
Yeah, because the reality is we can't help people. We can help people prioritize to some extent, but it ultimately comes down to what's important to them. I can't tell you what's important to you. You know what's important.
That's correct.
Everyone's priorities are different. So really understanding what your goals are and then aligning them, and then it comes down to prioritization, and that could be with spending in particular. What's more important to you? Saving for retirement or saving for a future goal, buying a house or whatnot, or going out to eat X amount of time.
Right.
And that's where it really becomes personal as to what is important to you and what are your priorities.
Right. And I don't know if this is one of the questions that's going to appear later, but, understanding your cost of living. Mm-hmm. And I know one of the things that I've historically done is I'll ask somebody, hey, you hate the term budget. Budget's like a bad word. People don't like to think of budgeting because they feel like I'm going to be telling them that you can't spend money on this or that. No, what I want to first start with is not budgeting, it's where's your money being spent?
Yeah.
And so you'd be surprised if I said to somebody, and this is standard, if I said, do me a favor, come up with what your list is as to what you're spending, and they might come up with $6,000 or $7,000 a month.
Mm-hmm.
The reality of it is that whenever they do that, I will tell you that almost inevitably they're going to be about 30% short on what their actual expenses are, mainly because of discretionary spending. They're not thinking of discretionary spending. And there are ways of figuring that out.
Yeah, and to your point, people know that the fixed payments, people know. So they're the ones that they're able to rattle off right away, list them, get them down on that piece of paper. It's I think I spend about this on gas, or I think I spend about this on eating out. That's where that underestimation really comes through.
Yeah, and I did that years ago. I created a spreadsheet and I literally tracked every expense. I would keep receipts if I used it for cash. I would keep my credit card bills that would show what was on a credit card, and I would keep bank statements in the event that I did it in any other form, whether it was an automatic deduction from my bank account, or a car payment, or a mortgage, or I used my debit card. Basically, I was pulling that together, and I had a very detailed spreadsheet. But once again, that is very important to understand where your money is going. And I can't help but laugh because I had every stinking column that you could possibly imagine. I had the mortgage, I had the home equity loan, I had my car, my wife's car, gasoline bills, clothing, grocery bills, eating out bills. I had columns for what I would consider everything known to mankind. And then I had my final column was other, miscellaneous. And the irony of it is the miscellaneous column was almost equal to the single largest other column, which was my mortgage. So effectively, I had my mortgage and my discretionary column of the, not even car repairs, because they showed up on it was amazing how much goes into that, which is why people are usually falling short when they estimate.
Exactly. I mean, and it kind of jumping ahead, but do you want to talk a little bit about the best methods for tracking your spending? I know that one of the questions was...
It is.
What is the best way to track my spending?
All right. Well, there you go. That? So I'd love to, because of the fact that I kind of walked into it already, is I always like to reference, and we deal with clients all the time when we're dealing with doing comprehensive financial analysis. If we're looking at what your goals, objectives are, first of all, we need to understand your cash flow. Or if you're projecting retirement planning, we want to know how much money do you want or need to live on a monthly basis. So I always jokingly, but not jokingly, say, would you rather do it the hard way or would you rather do it the easy way? Everybody always answers the easy way. And I say, all right, well, in that case, would you rather do it the accurate way or would you rather do it the less accurate way? Well, everybody always wants to do it the accurate way. Well, the irony of it.
And that's where some people will tense up at that point. Like, well, the accurate way must be the hard way.
That's right.
Not necessarily
and
the
it's
case.
not. Okay, so if you really want to find out and understand what your spending is, what you do is you take a look at, most people operate with a checking account as their main operating account. And they may have a savings account, which is overflow, or they have an investment account, whatever the case may be. But what I say is you take 2 finite periods of time and you look at the beginning time, let's say January 1st, and you look at January 1st of the following year, or June 1st to June 1st, whatever. You go from one point to another point and you measure, and by the way, going January to January is always the easiest, but it doesn't matter, is you take a look at how much did you have in your checking account at the beginning of the year? How much did you have in your savings account or investment account as far as deposits go? And you look at it and you say, all right, well, I had X number at the beginning of the year, and at the end of the year, I was $10,000 more. Well, that means you saved $10,000. Great. Now we go in and figure out how much did we deposit into your accounts. And if both of your paychecks combined and whatever other sources of income you may have came up to $130,000 and you saved $10,000, that means your cost of living is $120,000 a year, which is $10,000 a month. And I will tell you, inevitably, if I said to that person, yeah, your cost of living is $10,000 a month, almost to a T, everyone comes back and says, no way.
Yeah. And I think what we also run into is people with the one-time expenses. We'll say, well, this year was different. The water heater broke. That was $10,000. That's a one-time expense. And we always caution people with that, because when you work with people long enough, you'll see that they'll often have a one-time expense every year. Well, maybe last year it was the water heater. Maybe this year it's the HVAC. Or next year it's the car. So even though you may think something's a one-time expense, it's always good to plan for that one-time expense, especially when you're budgeting and figuring out your cost of living.
And there may truly be one-time expenses. For instance, if you paid for a wedding, hopefully that's one time.
Yeah.
You might have dropped 40, 50 grand for a wedding, okay? So that's something you pull out. Or a college education, you may pull that out. So really, you want to look at that as those are arguably one-time expenses. So we're actually at a good breaking point here that we can take a short break. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. welcome back to Financial Planning Explained. And where we left off at the first segment is we were getting into the tracking your expenses. And the easy method and the accurate method is what I did, or at least what we explained. What I did years ago was the difficult way of doing it, which in that case was accurate, but tremendous amount of effort that went into it. But Nick, why don't you pick up on other ways of tracking expenses? Because there are ways that you can do it through the internet and certain apps.
Exactly. So I think the starting point that Mike talked about is a great place to start at, where you look at a broad comparing your bank statement on January 1st to January 1st of the following year. That's a great place to start. The next step, once you get there, is where you really dive down into the individual expenses. And that's where you can use the apps out there, the Rocket Monies, the You Need a Budgets, the Empowers of the world. There are softwares out there that will aggregate all your transactions. So you'll link your credit cards, you'll link your bank accounts, you can link investment accounts, and it'll aggregate all your transactions and categorize them for you. Now they do take a little bit of training sometimes. Sometimes you can add rules into them that say if it's from this store, it's this category. You can add categories, you can customize it however you like. But I think there's sticker shock when you do the method that you were talking about, where people say, no way I spend $10,000 a month. There's sticker shock there, but there can be even more sticker shock when you start to use one of those apps, because then it really categorizes it, and then you can really see how much you're spending eating out. You can see by vendor, how much are we spending on Amazon? I know that's a very big one. People say, I can't believe we spend this much money on Amazon, because what oftentimes happens is it's the little things that add up. Oh, it's only a $20 order now. Oh, it's only a $50. It's not that much money in the moment, but when you're doing that over the course of a month, it adds up. So I think first step, looking at the broad approach that Mike mentioned. Second step, especially if you're trying to curb your spending, and I think that's where you really need to take that next step. If you're overspending and you're not able to meet your goals, or you're in the negative every year, that's when it really makes sense to dive deeper and figure out exactly where your dollars are going on a more zoomed in level.
Right. And so not only is it for helping you with cash flow, especially if you're running negative, because it's what it does. It shows you where it is being spent. But we oftentimes recommend this for people who are approaching retirement, because what this does is it allows them to ascertain what exactly their expenses have been, and they may be able to then make adjustments that say, well, I'm not going to be driving 50 miles a day to and from work. Therefore, that's going to have a lesser impact. I don't have to buy all these certain clothing for work. But on the flip side is we plan to add certain things. So doing the deep dive has a lot of valuable results. Again, understanding where the heck it's going, and then for being able to project and even budgeting. Because a lot of people do like to budget.
Yeah.
And it can have a very good effect.
Yeah, I think that leads perfectly into the next question we have is, how can I reduce my monthly expenses without drastically changing my lifestyle?
Exactly. So you can't reduce expenses without understanding what the heck they are. And if, to your point, if all of a sudden you realize, hey, you know what? We're spending $1,000 a month on Amazon, okay, which is tough because you don't know whether some people may buy their coffee through Amazon instead of buying it through the grocery store. So unless they're capable, do you know offhand if the apps are able to ascertain what it is that you bought?
Not the ones that I've seen. You can maybe say specific dollar amounts, because if you know a bet, you could give it a range and say, well, if it's this amount of money, then it might be toilet paper, it might be paper towels. But the ones I've used, at least, they don't tell you what specifically. Because think about your credit card statement. That's where it's pulling from. On your credit card statement, it's not going to say Amazon paper towels. It's just going to say Amazon.
Right.
So it has no real way of knowing what you actually bought.
Well, so what it does from a categorization. When I did it, it was remarkable. And by the way, teaching it, the perfect example is Wawa. So if you go to Wawa and it's $7 or $8, the odds are it's coffee or sandwiches. If you go to Wawa and it's $40 or $50, guess what? I'm getting gas. So that's where you train it. But what happens here is then you can see how much am I spending on gas every month? How much am I spending at Wawa for sandwiches? And most importantly, it's remarkable how many of the lattes and stuff that you get from Starbucks or whatever that, can't go my day without my latte in the morning. Well, guess what? You do $5 a day, or however, I don't even know how much they are. Okay. is $5.
That might get you a basic coffee
Okay, so
from a Starbucks.
why? How much does a latte or something like that cost?
I don't drink coffee. I have no idea.
All right. So anyway, so even if it's $8, okay, so that's $40 a week. That's $160 a month. That's almost $2,000 a year. And one could easily project out. If I did $2,000 a year instead of going to that, and I drove it into my 401k, it's remarkable. We're talking about hundreds of thousands of dollars that makes the difference later when all it is just satisfying a current want. It is definitely not a need, it is a want. So how do I reduce my monthly expenses? How much are you drastically changing your lifestyle by, instead of going to dinner 5 nights a week, you go to dinner 1 or 2 nights a week, or takeout, or whatever. Or instead of going and getting your latte every day, let it be a once a week. Again, goes back to the first question, prioritization.
Exactly.
And so that's how. The best way to understand it is to know what it is, to be able to reduce it, and to reduce it, and again, you need to know what it is. And then you could budget. And you can budget and say, all right, I'm not doing away with my lattes, but instead of, $300 a month on lattes, I'm going to say I'll do $100 and then budget around it.
Yeah, and I think there's a negative connotation associated with this question from the standpoint of drastically changing your lifestyle is a negative thing. I think you could also turn that around and view it in a positive light of how can I change my monthly expenses so that down the road I have a much better lifestyle and I'm able to meet my goals. And I think if you think of it in a more positive way, instead of I'm missing out on my latte every day of the week, it's I'm going to be able to retire a few years earlier. Or I'm going to be able to buy that house sooner. I think switching and training yourself to think differently about it is also very important.
It's positive reinforcement.
Exactly.
Good.
Exactly.
All right.
One of the other questions was, what is the 50-30-20 rule for budgeting? I know if you Google budgeting or you're looking to start doing budgeting, this is one of the first things you may see. So the 50-30-20 rule is just a general principle that 50% of your income goes to non-discretionary expenses, so rent, mortgage payment, gas, the things you cannot live without, you need them to survive. The 30 is 30% of your income going to discretionary expenses. That's more of the fun stuff, eating out, going on vacations and whatnot. And the 20% would be for savings, so trying to save 20% of your income. This is a general principle, and really it's certainly not a one-size-fits-all approach. It's just a general that you can follow. If you can save 20% of your income, that's always going to be a good thing.
That's a lot.
That is a lot of your income. So if you can do that, I would say that the 50 and the 30 maybe isn't necessarily as important. And once again, it all comes back to what your goals are. If you saving 10% of your income helps you achieve your goals, well then you don't need to save 20% of your income. It's all about what your goals are and how you can achieve them.
Yeah, to be perfectly honest with you, Nick, I hate that rule of thumb because fact of the matter is that if you're spending almost as much, 30% versus 50% on discretionary, you're spending a whole lot on discretionary. Fact of the matter is it almost seems as that most people are going to have about 60 to 70% of their income is not discretionary. It's their mortgage, it's their car payment, it's their student loans, it's their utilities, it's their, all that adds up to then they only have a little bit left over to be able to go discretionary and or savings. Unfortunately, a lot of people will also, again, this is where it really becomes prioritization. Forget whether it's 50-30-20 or 70-20-10. What it really comes down to is prioritization is savings versus discretionary. Because if you prioritize, I want to retire early, well then your discretionary spending should be lower and your savings is higher. And there's a whole lot we're going to talk about because the next episode we're going to talk about retirement planning. Even though if you look at the 6 areas of financial planning, it's second to last, follows that natural progression. The fact that all of this information as it pertains to budgeting and things in prioritization in your financial plan, most people do a financial plan to look at their retirement. Can I get there, et cetera, et cetera. So it follows like a natural progression from this particular one. So kind of gave the foreshadowing. The next episode is going to be on retirement planning. So I kind of babbled a little bit on that one. So the 50-30-20, again, it's a rule of thumb. There's the thumb. I think the thumb's missing on this one. So anyway. All right, so the next question was, how much should I be saving every month? Nick, you want to take that?
It's I almost sound like a broken record here because it really does come down to your specific goals and your saving goals in particular.
Right.
I would say as much as you can, or as much as you need to achieve your goals. And I think one thing I always try to instill in people, especially when they're younger, is the best years for compound growth are your 20s and 30s.
Correct.
So the more that you can put away when you're in 20s, 30s, the better off you'll be in the long run because of the power of compound interest. So I would say, once again, comes down to your savings goals, what your priorities are, but I would say as much as you can. You're never going to be kicking yourself down the road for saving as much as you can. Obviously, you want to live a little bit. I'm not saying don't have any fun or don't live your life at all now, but save as much as you can, and it gives you the flexibility in the future to live your life how you want to live it. Saving more now may be the difference of retiring at 60 versus 62 or 60 versus 65. And I think some people don't necessarily think ahead with that. So I think as much as you can save, you'll always be better off for it.
Wait a minute, I'm 60 years old. I saved too much.
Exactly. You're not going to be kicking yourself.
Exactly. And so to Nick's point is it's goals driven. And goals are definable and measured. So one goal may be in 3 years, I want to buy another car. So first of all, you identify what the vehicle is and what the cost would be. Are you going to buy new for 60 grand or are you going to buy used 30? Okay, and you say, all right, well, how much do I want to save to either put it down, I'm willing to have a loan, or I don't want a loan? So very simply, we say if I'm going to be putting $30,000 on a car for 3 years, what we do is we figure out how much do I need to save.
Exactly.
Okay, with no interest, it's 36 months, it's going to be somewhere in the order of about $400 a month, right? $400 a month, whatever that number is. Actually, it's more than that. But anyway, so that's another way. Actually, it's closer to $800 a month. But be that as it may, how much do you save is going to be predicated on what is the goal, specific goal, and how long is it until you achieve or want to be able to utilize that goal. So it varies from every person, but and nobody has only one goal. There's typically a whole slew of goals. It could be buying a car, it could be buying a house, it could be buying a shore property, it could be buying or retiring at a certain age. There are a multitude of goals, but again, if you don't really have a goal, it's kind of hard to define, right?
Yeah, to work towards it. And I think one thing we always emphasize with anyone we're working with is how tracking a goal and tracking your progress towards that goal can be really encouraging. When you're talking about savings goals, specifically with debt, I know we talk about it a lot, is getting it on a spreadsheet. It makes that decision of, I'm going to spend $50 on clothes this month or $50 on paying down my debt. Maybe clothes you don't need, I should say, versus paying down your debt. And you see and you chart it and you see the real impact of your savings, either your savings going up, your debt going down. I think that's really motivating, and it helps a lot of people stay on track with their savings, stay on track with their expenses, staying on track with their debt payments.
Perfect. All right, we got one more question, and we're getting down to the end. How often, this is a great one, how often, arguably there's two questions here, how often should I review and update my financial plan?
I would say rule of thumb, once every 3 years, unless something drastic changes.
Right.
If there's a big life-changing event, you lose your job, death, disability, anything inheritance, having another child, it can be a slew of life-changing events. That's where you maybe want to go back to the drawing board. But I also don't want people obsessing over it, because there is too often. For some people, if you're constantly either checking your accounts or checking your progress, that can be there can be negative impacts that where you're constantly worrying about it, and especially when you're tracking maybe an investment. If it goes down for a month, there's a psychological aspect, oh my gosh, it went down for a month. And so I think general rule of thumb, once every 3 years, unless there's a life-changing event, and you don't need to overanalyze it. I would say caution people on overanalyzing.
Right, exactly. And particularly as you're getting closer and closer to retirement, it may be that you're going to be reviewing the plan a little bit more often. But one of the things that you find is that when you review your financial plan, sometimes it's impacted by a giant up year or down year in the markets and your investments. But it's remarkable how often it doesn't have as much of an impact as you might think.
Especially when you have a longer time horizon and you're looking at maybe a 20-year or 30-year plan. One bad year or good year in the market isn't going to drastically impact the long-term trajectory of the plan.
Right. So there is another question, but we'll kick it out to another episode. So thank you very much for joining us. And, so today we talked about, pretty much the general financial planning questions. How much do we save? What's the budgeting and tracking expenses and, all the different things that go into developing a financial plan. One of the main financial planning goals that we run into is retirement goals, and where we're going to go is we're going to take the next episode and we're going to talk about retirement planning, because this is a perfect lead in to that. So Nick, thank you very much for joining me in this.
Thanks for having me.
Thank you very much for joining us, and we look forward to seeing you next time on Financial Planning Explained. Thank you.